Hi, everyone. This is Jason Burek of Wall Street from E Street. Welcome back to another Wall Street from E Street podcast interview. Today's special guest is a returning guest. I've known him for over a decade now. He worked on Wall Street as a bond trader for many, many years. He's also a gold fund manager, a gold stock newsletter writer, and he writes the Short Sellers Journal, which does in-depth research on looking for kind of companies and sectors that will have macro problems with interest rates or the newest commercial real estate crisis. Dave Kranzler of Investment Research Dynamics, thank you for joining me again.
Jason, it's good to be on your show again. Good to chat with you.
So, Dave, we're recording this interview on Tuesday, March 26, 2024. We've had the US dollar gold price rally the last couple months. It looked like it was going to crash a couple months ago. And then Chinese demand, the private sector Chinese demand and Indian demand just absolutely exploded the last couple months, especially for Chinese New Year and the threat of the crash in Chinese real estate, Chinese stocks, and the threat of a yuan devaluation with the gold price. It touched 2,200. Recently, it's down to 21.76. The silver price is a little below 25 at $24.33. I want to get your thoughts on the macro situation, U.S. federal government spending first, before we talk about the fueling gold demand and gold stocks. What are your thoughts on the current macro situation? Do you think that the policymakers in D.C., the Federal Reserve Bank, are they going to allow deflation for a long period of time?
When you say deflation, or was that inflation or deflation?
Are they going to allow deflation? Because I mean, like, the narrative is that, oh, the CPI is coming down. We've had a hot CPI number in the last couple months, but the overall trend the last 6 to 8 months, the CPI is headed down, CPI is headed to 2, and the economy is strong, even though I would argue a lot of the government data is not accurate.
You don't have to argue that. It's not accurate. It's a crock of crap. I mean, there's a lot to unpack there, Jason. It kind of depends on when you use the term deflation. Are you talking about, a massive drawdown in financial assets like the stock market and the bond market, junk bonds, et cetera? Or are you just referring to, really inflation slowing down? The group speak that they use is disinflation. And so really deflation would be, if you're using deflation in the right change in prices context, disinflation would be declining prices, right? We still have, even though inflation, the way the CPI measures it, inflation slowed down a bit over the last few months, although it's reaccelerating now. We still have an overall increase in the general level of prices. And you can just go to the St. Louis Fred database and pull up the charts that show that. So, but the reality is, and you know this well, that the CPI is vastly understating the real price inflation. If you go to shadowstats.com, John Williams recalculates inflation the way it was calculated in 1980 before they started rigging the numbers in a major way. And also he does a 1990s version. If you go to how it was calculated in 1980, it's running, inflation's running, I just looked at it the other day, I want to say around 12% price inflation. So, honestly, the only way the government's going to slow down inflation is if they cut the crap out of the budget deficit and stop running a budget deficit, cut the crap out of government spending. And also, part of the problem is, and the reason why it's reaccelerating is that, despite this QT concept with the Fed shrinking its overall balance sheet, if you go and pull up the monetary base, which used to be called MZM, the monetary base, which consists of bank reserves and coin and currency in circulation, is up almost 10% since the end of February. So, and that's the most powerful form of money supply, because banks can take those reserves, and it's mostly an increase in reserves. Banks can take those reserves and leverage them, right? There's not even a reserve ratio enforced right now. So
yeah, the narrative that they point out to say that inflation is coming down is that the private lending and bank credit is coming down, but like you pointed out, the reserves are coming up. I do not think that they've gotten rid of inflation. I mean, from what 2020 to 2022, it was a lot of governments and central banks created many trillions of currency units. And maybe if things slow down a little bit, I mean, there's still a lot of embedded monetary inflation into the system that's forcing wages and prices higher. We're starting to see what you would call, I know you got an economics degree, what a wage and price spiral, and then there's higher energy prices too.
Right. I mean, there's a couple of the regional Fed banks that released their business conditions survey index today, and both of them showed that wages are starting to increase quite a bit. So, I mean, and you can't just look at what the Fed's doing in terms of the money supply and reserve creation. It also has to do with government spending and deficit spending. Because when the government borrows money and spends it, it's that borrowed money is money. It's and the only way to undo that is if the government were to pay it back, but they never pay it back. The amount outstanding of Treasury debt increases by the minute. So
well, plus interest,
that contributes quite a bit to inflation.
Well, not only that, so you have a lot of people in the government dole with the transfer payments, all the money, and there's anecdotal stories of $3,000 to $5,000 a month going to illegal immigrants. You have a lot of new government employees that have been hired the last 12 months. I think the largest net job creator is in Medicare, Medicaid, and other federal government employee jobs. And then, the interest payments on the debt. So like you said, all those deficits, I think most historians and PhD economists will not admit that these budget deficits are inflationary. I'm just seeing it all over the place, that trying to counter that these budget deficits are not inflationary historically.
Well, they can't admit that, because then they're arguing that we need to cut the government spending, and we need to cut the spending deficit.
Yeah, and I mean the projections for the next 12 months, no matter who wins in the White House, because the spending is going to be around 80% of the federal government budget is going to be locked in, regardless of who wins in the November election. I mean, we're looking at really high budget deficits, and they're assuming that tax collection increases by another $1 trillion. And they're assuming that interest payments on the debt are going to be really, really low magically too.
I don't see, I mean, I haven't looked at the tax collection numbers for, I don't know, maybe a month, but I know that revenues for taxes into the federal government have been declining. And that would make sense because, quite frankly, on a real basis, this economy has been contracting, especially in certain areas like manufacturing. So it would make sense that, and you've got more, the mix of the labor force is more part-time as opposed to full-time. So I
think the real economy is bifurcated too. So I think like there's the affluent who have benefited, who do not have high interest consumer debt. So they have all these assets like stocks and real estate and other stuff, and they're doing okay because they benefited from asset price inflation, or they're getting 4.5% on short-term treasuries. And then you have the rest of us, the 90% of us who are exposed to like credit card debt, auto loan debt, student loan debt, that type of stuff.
Oh, yeah, absolutely. I mean, you just described the Cantillon effect, which is those who are closest to the spigot when the central bank is printing money benefit the most. And you're seeing that because, the majority of the stocks are held by the upper 1%, not even the 90 to 99%. So, it's that class of income and wealth that has benefited the most from the money printing.
So you were on Wall Street during the technology bubble. You were still there. I think you retired from working at Wall Street Bank shortly after that. Is what's happening now with like NVIDIA and some of these artificial intelligence and semiconductor stocks, the microchip stocks, does that remind you a lot of the technology bubble?
Oh, absolutely. I mean, the stock bubble that's been inflated now it's much worse than the bubble at the end of the 1990s. Have you been following this Nylum Resources story? It bills itself as a South American gold and precious metals miner, and they're merging with some crap tech company, and they're going to issue preferred stock if anyone wants to buy it, to the tune of about 1.7 trillion and buy Bitcoins. So the stock was trading at a penny yesterday. And then after the announcement, it shot up to like 9 cents. and then it closed today at 26 cents. So, and I went to the company's website. They've got two crappy little projects in Peru that no one wants. You know, they're not a gold miner. They're basically a Vancouver listed shell game company.
Yeah,
So, and that's the kind of crap that you get when you're at the tail end of just a massive stock bubble.
well, have you also
This kind
seen
of
all
fraud.
the other red flag I see here with this tech bubble is all these leverage ETFs that are coming out for only like two stocks. So double or triple leveraged NVIDIA or artificial intelligence stocks or semiconductor microchip ETFs that are way over leveraged to dump onto retail traders.
Right. That's right. That's exactly right.
And those are I don't know when. I'm not good on timing on these things. The thing with bubbles is you can identify that they're a bubble, but you can't time them when they collapse.
That's true, and it's usually like, not any specific trigger. It just happens that, all of a sudden they start selling off. Like the way the market ripped in reverse this afternoon before it closed kind of made me wonder if, no, maybe we topped. Maybe today was the top, but probably not. I mean, I was day trading from my home at the tail end in 1999, and then for the next several years. And it's just like, you would watch a stock like Cisco go up, 20 points. And then you say to yourself, oh, it's got to pull back tomorrow, and you buy puts on it. And then the next day it would go up another 20 points. And it just seemed like it seemed like it was never going to stop rising. And then
That's NVIDIA. Yeah. I mean, like they're bringing analysts on business television who are saying there is no bear case for NVIDIA.
well, which, you know what, that's just a stupid thing to say. It's idiotic. I mean, it's, for God's sakes, it's semiconductor chips. To a certain point, yeah, NVIDIA's got a first mover advantage here with its technology, but you've got three or four other very reputable companies working on competing chips. And I mean, it's also going to be cyclical. I mean, part of what's juiced NVIDIA's revenues is that they introduced this AI GPU that's superior to anything else that's out there. And Meta, I still call it Facebook, Apple, Microsoft, they loaded up on and Google, they loaded up on these chips. They probably bought more than they're going to ultimately need because, there was limited production. And at some point, and also NVIDIA's, I mean, you've seen the articles about it. NVIDIA's been funding these like shady, sleazy little tech shells that say they're going to be hyperscalers and giving them the money to buy NVIDIA chips, right? So it's basically recycling the money
that
that
pad
NVIDIA
sales.
lends them to pad their revenues. At some point, a lot of these, a lot of this, there's going to be excess inventory of these H100 GPUs, and they're gonna be for sale on the market. It's going to drive down the price.
And you're talking about what CoreWeave and Gravatar Capital. I mean, there's a lot of other red flags.
There's other ones, but yeah, those are probably the two most prominent.
Well, I mean, like the other red flags I'm seeing is the amount of hedge fund leverage. So hedge funds are really leveraging up. And then I'm just seeing the attitude is kind of blasé attitude from a lot of traders, retail traders that, oh, I'll just keep raising my stops. So the higher NVIDIA goes, the higher some of these other tech stock go, I'll just keep raising my trailing stops and my stops and no problem. I'll get stopped out. All my gains are protected. Well, this, Dave, from a technology bubble that when everyone's trying to get to the exit liquidity, things do not work out as planned.
Well, and that's true. And if you put in a limit order, that doesn't guarantee that that's the price where you're going to get executed. That just means a sell order has been activated, right? Or you put in a stop, and you could put in a stop with a limit, but you might not get executed then. So
exactly, and it could gap down. Yeah, I mean that's what happens
right
at the end of a bubble, right? When it crashes, these things gap down, and people do not get their exit liquidity filled.
That's right, because everyone's rushing for the exit at the same time, and there's no buyers. Who's going to buy that stuff? The shorts will, trickle in as buyers, but the sophisticated shorts know what's going on. You're not gonna step in with a bid. I mean, when Nvidia is down 20%, then maybe you start covering some profit, covering some of the shorts and take profits. But it's not like you pointed out. It's the same dynamic that happened in the tech bubble. The Nasdaq dropped something like from top to bottom in a matter of about 2.5 years. It dropped something like 76%.
And the other thing I see people comparing price to earnings ratios for that tech bubble in the late 1990s, early 2000 versus today. There was no share buybacks back then, right? So there's been like over $1 trillion of share buybacks by the large cap tech companies post 2008 since then to knock down those price to earnings ratios and reduce the share count.
That's right, but there's also a major factor, and I'm surprised no one talks about it. I mean, I've been talking about it. Anyone who wants to listen, but the gap accounting laws have been loosened considerably since 1999, or the gap accounting standards, and it makes it much easier to create non-cash profitability, or pull forward profitability and recognize them in this quarter, and then wing it next quarter, and that affects the PE ratios. So if you applied gap accounting standards that were used in 1999 to the current, just the current S&P 500 or the current NASDAQ composite earnings, you'd substantially reduce the earnings per share that are recognized now versus the what's recognized by current gap standards.
Yeah, well, there's not much we can do about that. I mean, the government gets away, the Pentagon, the U.S. federal government gets away with even worse, but I'm not surprised. The one thing I'm not seeing, I haven't seen anyone come out with this, and I've asked like Jesse Felder and other hedge fund managers that have retired for charts showing the buybacks. I mean, like the amount of share buybacks by the large cap technology companies, so the Mag 7 and others, is just absolutely enormous. And that's why the price to earnings ratio now is so much lower than the last technology bubble. And then you have the insider selling. So the insider selling, the insiders, so like your Jeff Bezoses, your Bill Gates, Mark Zuckerberg, Jamie Dimons, I mean, they're large net sellers. So that worries me too.
No, absolutely. That's a signal right there that no one's paying attention to. Because, it's different this time.
It's different this time. I mean, like I study financial history a lot, Dave, and I'm seeing so many similarities to the 6 to 12 months prior to the October 1929 crash. There was also a technology bubble with radio stocks back then. There was also a commercial real estate bubble back then too, with skyscrapers and office buildings. The Empire State Building went unfinished for many years. And there was a ton of flight capital with a lot of the other major economies back then that came into the United States stock market back then too from other countries because those other countries were already in a recession or depression. Just so many similarities.
Yeah, absolutely.
Yeah, I think the other major thing is how much flight capital. So I think that's a major theme with why gold is doing well with flight capital and also with Bitcoin is what's going on in China. But first, I want to ask you your thoughts on the commercial real estate market and regional banks, because you just put out a piece today for free that my listeners can go read on your website, your blog, Investment Research Dynamics, about commercial real estate. We were talking before we started recording. Do you think that this is still early innings, or do you think that we're starting to get further into the crisis?
Well, I think we're getting further into the crisis, but it has a long way to go before it capitulates and reaches a bottom. I mean, part of it is, as we were discussing, lenders are giving borrowers loan extensions, or they're finding creative ways to cure delinquencies, but it's kicking the can down the road, and it prevents those measures are, it prevents the owners of these buildings from having to sell them. But at some point, you're going to run up against limits of that, unless the Fed just prints money and hands it to the borrowers and then hand it to the banks. So I think I saw a stat when I was doing research for this article that I posted on my blog. It was the intro to my latest short sellers journal, which is a weekly publication. Something like, there's of all the outstanding troubled situations across the country, there's only been something like 3.5% of them have been, ended up with sales. And so at some point, there's just going to be an avalanche. I mean, you saw the report about the sponsors of, there's 2 buildings in San Francisco that were just written down to zero, right? Because
Well, I don't think there's enough buyers. So there's tons of players, and a lot of them actually are pension funds and insurance companies. It's not necessarily just regional banks that want to sell. There's a ton of sellers,
right,
and there's hardly any buyers.
right. Well, I mean, why would you, step in front of a runaway freight train here? Because that's what this is. You could buy a property this week thinking you're getting, at 50% off of the last sale price. And then all of a sudden, a year from now, you're down 50% on it because there's just so much excess capacity in commercial real estate, office buildings, multifamily is gonna the rental units available in multifamily are going to go parabolic this year. It's going to be the biggest influx of multifamily units to hit the country since Nixon was in the White House. So
I think it's a perfect storm for commercial real estate because before the pandemic, they were saying that it was way safer. But then because of artificially cheap interest rates, you had here in the DC metro area and other areas, you had a teardown boom. So you had all these real estate developers because of cheap rates. They just went and bought all those strip malls and knocked them all down and started building mixed use buildings with a couple floors of retail, expensive retail and restaurants on the first couple floors and luxury condos and stuff. And that happened throughout like many metro areas.
Right. So, I mean, I've seen reports where it's some of the larger cities with the worst problems. I mean, office buildings are 50% vacancy rates or higher. I mean, why would you buy a building like that? How could you possibly think that you could fill it with tenants, even though you can lower the rent substantially? Why would you step in front of the freight train and buy that building? Because it's going to get cheaper. And in terms of multifamily, that people thought that was safe. It's not safe. There's a ton of capacity that came online over the last couple of years because of the easy money and low interest rates provided by the Fed. I've got a business. My business partner also he does. He's got a side business where he rents. He's with a company where they rent rental equipment to construction companies, and these are the companies that are putting up these multifamily buildings in the Denver metro area. And one of his clients told him that there's over 1 million units in the Denver metro area, not just downtown Denver, central Denver, over 1 million units under construction in the metro Denver area. I mean, that's going to flood the market with capacity, and it's going to drive rental rates down.
Are those multifamily? So those are apartment buildings?
Apartment buildings, yeah.
Okay, because I thought we were talking about office buildings still, but I mean, like, there's the argument that people are saying, "Oh, we'll just convert the office buildings to apartment buildings." I mean, I think the average person who says that doesn't realize how cumbersome, time delayed, and in like areas like New York City or Los Angeles, how expensive it is. I mean, it could cost over $100 million
right, but
to convert a single building.
Market doesn't need extra multifamily capacity. It's been flooded, and the flood's going to get worse this year.
Well, I was watching a 60 Minutes mini documentary for converting, like, this was near Wall Street, converting an office building into like luxury condos. And the real estate developer said it was going to cost hundreds of millions of dollars. So, I mean, if that's per building, that's very, very expensive.
Right. And that's New York, and it's less expensive in other cities. But again, the market doesn't need the capacity.
Yeah, I agree. Even though people are saying, oh, there's a lack of inventory for single family homes. But I mean, like at the current mortgage rates, I mean, most people don't even qualify for a mortgage and can't put 20% down. And we're seeing that in the data that you need, $115,000 annual salary now to make the basic mortgage payments on the average median family income home.
Yeah. I think that statistic assumes a 10% down payment.
I don't know where they'd get the rest. Maybe an FHA loan. They're going to scam FHA to get that first-time home buyer discount or something. Maybe borrow or beg from family or friends. I mean, that's how like a lot of the young adults in my area get their first condo purchase or their starter home. Is they have to get the money from friends or family members. Normally, it's a parent or grandparent who's either paying for the whole mortgage or a large chunk of it. or buying the whole house.
Yep.
Now, Dave, since you are an accounting expert, you have degrees in accounting. The banks are claiming that they can hold to maturity on these treasury bond losses with the Fed rate hikes, but I interviewed Ms. Shedlock. He said that the real losses that the banks can't do the accounting tricks with, really only a little bit, are the actual losses on the commercial real estate, the office buildings, the multifamily. Do you agree?
Well, I mean, other than, gimmicks like loan extensions, yeah, no, I mean, how do you plug that hole? If you've, let's just give a simple mathematical example. You lent 100 million against a building that at the time when you lent it, the building was appraised for, call it 130 million. Fast forward to now, and you still got, let's just say there's still 90, maybe even 100 million still outstanding on the loan, but the building's only worth 50 million now, and then multiply that over dozens and hundreds of buildings. How do you plug that hole in your balance sheet?
You don't mark any of the losses and you extend and pretend as long as possible.
Well, that's right. And I think that's part of the reason why the Fed has juiced bank reserves per the monetary base numbers, because it gives the banks some liquidity so that they don't have to foreclose on these properties, or they can give loan extensions and not even declare them delinquent.
But the losses will have to be incurred eventually, right? So, and that's why you're seeing the warnings from these consulting companies. Even the FDIC has conservative estimate losses at $600 billion. And I think that's low. But there was a research report that said 300 regional banks are already in trouble.
Yeah, that wouldn't surprise me. That wouldn't surprise me at all.
So you think then this is, it's not a question of if, it's a question of when for bailouts then for dealing with this commercial real estate crisis?
I mean, it's going to be tough for the Fed and the government to make the argument that, the taxpayers have to bail this stuff out. Like I said, I mean, there's just so much excess capacity in the commercial, in the office building space, and now, in multifamily. I mean, you're never going to be able to fill these office buildings. And so you say, oh, well, we'll bail them out. And then when things get better, we'll sell the buildings and pay off the bailout loans. Well, no, I don't think that time will ever come.
Well, I'm not in favor of bailouts. I'm just saying that the people here in DC are going to say, well, if we let all these banks fail, then there's the derivatives, then there's the potential that a few of these regional banks are kind of like the size of Silicon Valley Bank or First Republic or larger. And then they start to create counterparty risk, contagion, problems in the derivatives market. And then that's when the other banks or pension funds or hedge funds that bought some of these derivatives start to get in trouble.
Well, and that's the thing, that another thing that no one's talking about are the OTC derivatives. And they say, oh, well, the too big to fail banks, it's a small percentage of their asset base, of their loan base that's exposed to commercial real estate. Yeah, well, that's the stuff that's on balance sheet. They all have underwritten OTC derivatives on commercial real estate, the mortgages themselves, on the CLOs, the different types of structured mortgage products. All of that has credit default swaps and interest rate swaps wrapped around it. And that's what really pushed the system to the brink of collapse back in 2008. It was the OTC derivatives. Yeah, the defaulted mortgages were a problem, and it was going to be a painful problem for a while, but it was the leverage that you get from these OTC derivatives that just, that's what really caused the system to melt down.
And it's not just in the US. We were talking before we started recording, there's commercial real estate problems all over the European Union, in Germany, Deutsche Bank.
Yes.
Their new problem now is their commercial
China.
real estate loan book. But all these global pension funds. So I was surprised to learn, I've been learning this the last month or two, it's all these foreign pension funds. They were all buying basically these office buildings, multifamily here in the United States, thinking that it's very safe income. Oh, the cash flow numbers look great. Oh, rents can keep increasing. And so they bought hand over fist insurance companies too.
Yeah, no question about it. And again, pension funds are big investors in commercial real estate because it pays the loans pay a higher rate than treasuries or standard residential mortgage-backed securities, that type of thing. So,
Oh
you know,
yeah, before I remember before the pandemic that the pension funds were advertising that their largest investment percentages were all in like tech stocks, the riskiest stuff, private equity and commercial real estate. Those were their three largest holdings.
yep.
Well, I guess they're going to need bailouts or they're going to need to raise taxes on tourism like in California like CalPERS has been doing. Because CalPERS has, I think, more losses than anyone on a lot of that stuff. I mean,
CalPERS is radioactive. I mean, if you're a future beneficiary of CalPERS, don't count on that money.
well, unless they're taxing tourists like 20 or 30%, but then I guess
They're not going to be able to raise the kind of money that they're going to need to bail out CalPERS.
So let's transition to gold then. I think bailouts, unfortunately, I'm not in favor of them, but I think the people here in DC, I think they're already being planned. I mean, I've spoken to sources because the Federal Reserve Bank, the New York Fed, there was the 60 Minutes mini documentary. The New York Fed's been getting presentations for the last 6 months. It was mentioned in the mini documentary for 60 Minutes. They know that commercial real estate is insolvent. The math doesn't work. One of the New York Fed directors is a very successful commercial real estate investor. I sent you his tweet, Dave, from like 18 months ago. He just laid out the math. They said by 2025, almost $2 trillion of commercial real estate loans are insolvent and bad.
Yeah, that wouldn't surprise me.
So there's going to have to, I'm not in favor of bailouts, but unfortunately, this is the path of least resistance for the people here in DC because it's not their money. And if they do bailouts for their friends, I mean, that means with the revolving door of corruption, they're probably going to get favors or a high paying job later.
Yep. It's also going to create massive price inflation.
And the Cantillon effect again. Here we go. Even more of it. It just feeds on itself.
Yep.
And do you think then with the budget deficits and the foreign governments looking at bailouts, do you think this is why these so China, Germany, Japan, they're not the net buyers of treasuries anymore, and this is why they're buying gold tonnage?
Well, I haven't seen numbers for Germany. I'm not aware that any of the ECB central banks are buying gold right now, but that's for sure in the Eastern Hemisphere because that's where in the Middle East that's where the majority of the central banks are that are accumulating all this gold.
Well, I mean, Germany was running large trade surpluses, right? They were the main star of Europe, right, for economic output, right, for GDP and productivity for a long time. So they were recycling that into treasuries. You're right. They weren't buying physical gold, although I think they did ask for their gold to be returned.
Yeah, they did. That was a whole other ordeal for another conversation that was amusing to watch.
Yeah, but you're right. If they're in the G7 or NATO, they can't because they're basically a vassal state. They can't go and buy a lot of physical gold tonnage because then DC is going to get pissed. But they did ask to have their actual gold already returned. So, but the other countries that are not in the G7, I mean, they're not buying the treasuries that they were in the past with their trade surpluses.
I don't really pay that much attention to treasury flows. I just know that foreigners, the big buyers, the ones that matter, which would be the OPEC countries, Japan and China, they're cutting way back on the amount of treasuries that they're buying.
And then meanwhile, DC needs to sell more, right? So it's literally a supply and demand issue because of the size of the budget deficits and interest payments on the debt. So it's literally a supply and demand issue with treasuries.
Yes, it's gonna get really ugly. And again, that's another reason why the Fed's gonna have to crank up the printing presses again, because if they let with the flood of new issuance that's coming, if they let the market determine the rate that would clear that paper, it's gonna drive interest rates up quite a bit on Treasury paper.
What if they just changed the leverage ratios and the accounting rules and they just shoved as much of US Treasuries as they can into the banks up to the gills? Do you think that they can buy time with that, or do you think that that's going to fail?
Well, they removed the reserve ratio during the pandemic period. So that's not going to be something that they have to change. I haven't really thought too deeply about how they're going to try and figure their way out of this one. I mean, there is nothing you can do. I mean, ultimately, in order to fund the spending deficit in DC, you're going to have to print money or let interest rates rise enough to attract enough foreign capital where they have to say, oh, geez, the 10 years yielding 10%. I have to buy some, that type of thing.
Well, that math
But I
doesn't
think
work.
when
I
you
mean, the
get,
10% interest payments on the national debt growing, I mean, that means then that the highest line item expense is going to be interest payments on the debt, and then the debt keeps growing at a faster and faster rate.
well, it's getting close to being one of the largest line items already. But I think the problem is if you get into a situation where the U.S. has to pay 10% to issue 10-year paper, I think you're going to be in a massive dollar crisis anyway. So,
Well, the narrative publicly, Dave, in the non-gold and silver people is like fiscal dominance and in financial repression, but fiscal dominance just sounds like marketing spin to me because I mean the Fed has been warning all the Fed chairmen for the last 10 or 15 years that DC needs to reform its fiscal spending, and the Fed and both political parties in Congress and the White House just ignore the Fed. And the Fed just subsidizes the spending anyway.
yep.
So I think like this whole fiscal dominance, everyone's like fiscal dominance this, fiscal dominance that. I think it's just basically more of the same. I don't really see big changes.
No, it's what the things they've been doing are just getting worse and more severe.
Well, I expect for the average person on Main Street, if you don't have a lot of assets, you have a small business, I see more stagflation, shrinkflation, and taxes because the average person here is getting squeezed in this bifurcated economy, especially if you're exposed to higher interest rate consumer debt.
Yes, that is correct. And I mean, you're seeing that in the various consumer surveys that go out there. I mean, the under 90% are just getting decimated financially.
So I want to transition now more towards gold and silver. I know you've been covering gold and silver markets for over a decade. Is this the first time you've seen where physical demand out of China in a sustained way has overwhelmed the paper markets and GLD and SLV, the outflows before?
Actually, I've been doing this since 2001, but you don't really know for sure the extent to which China has been buying a lot of gold all along. I mean, I'm sure you've seen the work from Alistair McLeod, where he wrote an in-depth article and did a lot of research and came to the conclusion that China had been buying massive quantities of gold at least back to the early 80s. And that, I think anyone who's looked at this seriously knows that the number reported by the PBOC is not even close to the real number in terms of the amount of gold the PBOC holds. So back then, and I forget how old the article is, but you can find it if you use Google. I think he was estimating that the Chinese were probably held somewhere in the neighborhood of 35,000 tons, which means they have a lot more now. So,
And that's what is that the government? That's not
the numbers of the gold that flows in and out of the Shanghai Gold Exchange and that's flowing into China via Hong Kong. Yeah, I mean they're buying record amounts of gold right now, but that doesn't account for the gold that flows into China through Beijing, which China opened up Beijing in 2014 for gold imports. And the article in the South China Morning Post, the byline specifically said the reason why they're not going to report the numbers, the amount of gold going into China through Beijing, was so that the PBOC could be a little more discreet with what it's doing with gold.
I think at this point, the most reliable numbers I see for China are the Swiss export data, and those are very, very large, but that's private sector Chinese demand. Same thing for the amount of Swiss gold export data into India.
Right, and that gold goes through Hong Kong into China.
Oh, it doesn't go into Shanghai too?
Beijing. Actually, I think they do import gold through Shanghai also. I mean, I suppose it could. I would just say if you use the World Gold Council number, the Hong Kong number, and the Swiss refinery numbers, that's still low on the low side of what is actually flowing into China. And don't forget, China's actually, as a country, they're the largest gold producer in the world. They produce something like 400 tons a year. And from the research that I've done, basically the PBOC hoovers up all of that gold.
Well, they also subsidize it. They're government-sponsored enterprise mines. I mean, the miners are not for profit. I mean, Jim Rickard said that the cost of some of that gold mining was subsidized. It was over $2,000 an ounce years ago. So it's not economic gold mining. The Chinese government just is subsidizing the gold mining inside China. They're pulling all the gold production forward.
That could be, I don't know. I mean, technology has changed enough from probably when Rickards looked at it that, it's reduced the cost of mining.
They were jobs programs, though, Dave. They weren't using a lot of automation, so they're actually using a lot of physical workers. At one point, it was on bicycles. So there were some silver mines in China. They were having workers go in on like bicycles. So I don't know if they're still doing that, but they were even after 2008 financial crisis.
Oh,
They were literally, yeah, they were jobs programs. So like there's Chinese state-owned enterprise like steel companies and aluminum companies. There was a lot of not-for-profit manufacturing there for base metals and steel and stuff like that, and aluminum.
Well, that's how communism works, right?
Well, at least they're making stuff, right? Instead of just like paper derivatives and bailouts and U.S. federal government employees for woke programs.
That's right.
At least they're stockpiling steel that can be used later, or copper wiring that can be recycled.
Yes.
So I'm going to transition now to mining companies, which you cover. The mining companies, one would think that they would have been doing very, very well lately, but there's a huge disconnect between the gold price and the valuation on the gold stocks. Have you seen a disconnect this bad between the valuation on gold stocks and the gold price before?
I mean, it depends on how you run the comparison. And I haven't, I guess, let me just see if I can pull this up really quickly. But yeah, and the thing is, it's kind of different for each individual company. Like, it's on a company by company basis. Some companies have much higher, and let's just use the all-in sustaining costs. I know some people think it's a controversial measure, but I mean, it's a tool that you can use to compare costs across miners, whether it's 100% accurate or not. It, doesn't, who cares?
Well,
But
it's still way better than the old cash cost metric. That was bogus.
yeah, no, you can't use the cash cost, but well, you can. I mean, it is a benchmark, and it's a useful benchmark. But yeah, it doesn't it's not fully representative of the total cost of getting gold or silver out of the ground and refined, right? So, or processed. Um,
Well, I've been covering mining stocks for a long time too, and I used to email like those Canadian investment bank analysts, and when the cash costs would get reported, you'd see the miners. This was like 15 years ago in 2008 or 9. They'd say, "Oh, our cash costs are $600 an ounce," and then the miner would have a loss. And then like I'd email the Canadian investment bank mining analysts that were covering stock, and they'd say, "Oh, just multiply the cash cost times 2 or something like that." Some of them it was times 3, though. They were that bad on the cash cost to the real cost.
sure. So I've got a chart here that it's the gold ARCA Gold Bugs Index ratio, and I use that because I take this chart back to 2001, and GDX didn't come into existence until 2006. So, and I like to go all the way back to when the secular bull market in precious metals started, which is 2001, and this ratio right now, in that time period, the only time it's been higher was a brief moment in 2020, and that was the lockdown BS. We can throw that out. So it was the ratio. In other words, the ARCA Gold Bug Index is the 15 largest gold miners for the most part. There's some other companies in there that I don't think should be in there, but they are. But so the only time that it relative to the price of gold that this index has been higher, or these miners have been cheaper relative to the price of gold was in toward the end of 2015.
That bear market was brutal too. Yeah, you were around then. I mean, like people thought all the companies were going bankrupt. Every single gold and silver. I was getting emails about Silver Wheaton that they were going to go bankrupt. Franco Nevada, all of them.
Oh, and you mean in 2015 or?
Yeah, that's how brutal the bear market was.
Oh yeah,
Yeah.
no, that was brutal. So, I would argue that that was a little more brutal than what we have now, but it's pretty brutal right now. Part of the reason is just because, the cost structures are higher because of price inflation.
Well,
I also
also,
did this. I did I've got that ratio. I use the S&P 500 Arca Gold Bug Index ratio, and the only time that the mining stocks have been cheap, this any cheaper relative to the S&P 500 than they are now was back in 2001. So yeah, I mean, if you're a value investor and a contrarian investor, I think you have to take a look at the mining stocks.
yeah, I think that's an important point you brought up with cost rising. So for a lot of these gold miners, they just announced earnings in the last couple of weeks. We're seeing that costs for Q4 2023, that costs are still rising. So they're still rising 8% to 10%. They've actually outpaced the rise in metals price, except for the last month or so in the rise in metals price. And we're not going to get the costs and the cash flows and the profit margins until the Q1 numbers are announced by the mining companies. But overall, the industry for the producers, I was speaking to Frank Holmes, and he's a gold fund manager. I think he said he covers around 90 producing gold miners. He said that the costs are still overall rising faster than the metals price for a while now. So he said the profit margins and the free cash flow for a lot of these miners for years is not as good. The mid-tier miners, Dave, I mean, they have a lot of high cost mines. This worries me. I was looking through they have now, it's itemized for the individual mines of each miner. So for like an Equinox Gold and Alamos, the listeners out there can go through and look at the investors' presentations for each individual mine, the cost. There's not a lot of low-cost mines for these mid-tier gold miners. I mean, they have like one or two low-cost mines, and the rest of the portfolio are high-cost mines.
Yeah, Alamos is a different case. That's a pretty profitable company. I was just looking at its numbers the other day. Again, it's company by company basis. Like if you look at a company like Silvercorp, they have a very low cost structure. And so here's the thing: the way the dynamic works is that there there's periods of time where you're going to get a window where the price of gold has gone up considerably more than the cost of getting it out of the ground. And that's I was talking with a longtime grizzled veteran who started off his career working for the Rothschilds in London in their mine finance unit. So he's been around a long time. He's built mines. He's from soup to nuts. He's worked at larger companies, and he said, we'll get a sweet spot, and it might only last a couple years, but that's what you are in this business for, because that's when you're basically become a money tree as a gold miner or a silver miner, and we're not there yet. We were there back in say 2010, 2011, when gold and silver were both hurling toward record levels. Silver didn't quite make it. Gold set a new record, and don't kid yourself. For quite a few mining companies, this latest move in gold, I think we're going to see some pretty good numbers for the first quarter. Not for all the companies, and I'm not talking about Newmont and Barrick. I wouldn't touch those stocks with a 10-foot pole. But if you take like Fortuna Silver, I mean they've got their newest mine over in the Côte d'Ivoire in West Africa, and it's got a very low cost structure, and the profitability of that mine for the first quarter of 2024 has just got to be massive. So you got to look at these things on a company by company basis. My focus of interest in the sector, and it always has been, is the junior exploration project development companies. And there's some ones out there that are just, I mean, they're trading at 10 cents on the dollar. So, and that's, once we get a really good extended move higher in the prices of gold and silver, and it's coming, I'm not going to tell you when, no one knows. But once we get that, and it may have started already, right? With the breakout in gold, and now it's retesting the breakout area. It's holding above it. Silver it's not breaking out to all-time highs, but if it gets into the high 20s, I think we can call that a breakout. Um, some of these junior exploration projects, these companies, they're going to get bought out by the mid-tier and the large caps, who are going to have no choice but to buy them out because they've got good projects with demonstrated reserves, in excess of 1 million ounces. So that's kind of what I'm looking forward to.
Are we in an environment now, given that gold prices are right around 2,200, where a junior can say, okay, we can go get 5 million or 10 million or $20 million for a drill program, and we're fully funded for a couple of years. We're going to do a full drill program. We're going to start building out a resource at NI 43-101, a pre-feasibility. Are we there yet where they can actually raise money, not give away a ton of warrants?
Again, it's a company by company basis. I've seen some financings in the last 6 months where the company is able to do it with half a warrant. The market's gotten bad enough that it looks like most of these deals coming now, and we're talking about companies with market caps under $100 million. We're starting to see deals now where they have to issue a whole warrant again. But the point of it is that there's still large pools of capital out there that will invest in the sector and are looking for ideas to invest in. And by the same token, there's some junior companies that I'm invested in that are working on projects where they're looking at creative ways of financing, their future exploration. So one company is in the process of signing a deal to sell ore that it pulls out of the ground that it uses, for metallurgic testing, that it uses to create, what'll be, eventual mining stopes and tunnels. And it'll take that rock at 10 grams per ton, and there's buyers for it. So, and that's a good way to raise money. This company's, probably going to be able to raise 20, 30 million this way.
Oh, that's
There's
interesting.
another company that I cover and recommend and that I'm invested in, and they have a topsoil layer above the bigger deposit on the property that's a couple grams per ton. That's going to be extraordinarily cheap to mine, to process this material, and produce gold from it. And they already have a trial mining permit. And they, if everything goes smoothly, they'll be producing gold by the end of this year, and they'll be able to use the cash flow from that operation to explore and develop and advance the bigger deposit that sits, a little further under the ground on the property.
Okay, so it sounds like some of the juniors are able to get some funding done, but if metals prices can either stay at these levels or when higher, funding would be easier and at better terms. Are the juniors able, some of them who have maybe a pre-feasibility or NI 43-101, is there enough capital available, you think, to start building some new mines, maybe some new silver mines in Mexico? Or do you think that we have to have higher metals prices for longer?
I mean, again, it's company by company basis. I mean, if you look at Discovery Silver, once they get fully permitted, they're off to the races building their mine. And I don't think they'll have any problems raising money. So,
are they in Mexico?
Yeah, they're in Mexico.
Okay, because I have my listeners bring up the name Vizla. I interviewed another mining stock newsletter writer, Brian London, and he said Vizla Silver. So I think they're also in Mexico. So those are projects that could potentially.
They are in Mexico. They're in. I think they're in Sonora.
So those are potentially projects that will get funding for mine building then?
I mean, I don't follow Vizla very closely just because it's already got, hundreds of eyeballs on it, hundreds of newsletters. Well, not hundreds, but, many newsletters cover it. I look for ideas that are less well known and less covered. And these tend to be companies that spend most, if not all, of their money into the ground rather than spending a ton of money on promotion. Vizsla, is a heavy promoter, I think that because of that, there's not as much value that can be squeezed out of a company like Vizla as there is with a lot of the companies that I follow in my newsletter. So that's why I'm not that familiar with Vizla. But like I said, this company that may have a small trial mining program up and running by the end of the year. I mean, almost no one's heard of them, and they're an example of a stock that trades at 10 cents on the dollar.
Do you think that over the last 10 or 15 years that the capital available and the funding has changed a lot because of these mining stock ETFs, and how in Canada a lot of these merchant banks have gone away? Because the juniors, like when I first started covering gold and silver companies, there was a lot more merchant banks helping with fundraising, private placements that could get done. And it seems that a lot of these mining stock ETFs have taken a lot of capital away from those types of companies that could get funding.
Again, there's a lot of private pools of capital out there, PE firm, non-tech PE firms and things like that are look to invest in juniors. There's companies that have dedicated funds that invest in juniors. So I mean, if you look at a company like Orion Finance, I mean, that they're prolific investors in the sector, at all levels of the capital structure.
Oh yeah, Orion's going to cash out of the Greenstone mine, which is a super low cost high.
Right.
Yeah, they're going to
Right.
cash out of that. They have 40% stake in Greenstone, so that's going to go cash flow positive, hopefully in the next couple months. And then
You
they're
got
going to sell
companies
their.
like Dundee Precious Metals. They just took, within the last, I think it's like within the last year or 18 months, they took a 20% stake in a company that I've been following for a long time. I know the CEO pretty well. And it's the type of company that no one really hears of because he doesn't spend much money on promoting the company. He puts it all on the ground. He's in the middle of a drill program right now. And if it goes successfully, he's probably 18 months away to 2 years away from having an operating mine,
You
or
all
Kinross might buy it.
Well, you also have right there in Denver, you have the hedge fund, and they have a specific one for gold juniors and silver juniors. You have Crescott Capital with Tavi Costa and Kevin Smith, so they fund juniors too.
Right. And they weren't a source of capital 15, 20 years ago.
Okay, so it's more selective. It's still a smaller pool of capital. I mean, like there was tons of money. You've been doing this a long time, Dave. There was tons of waste, fraud, corruption, and abuse out of Vancouver for a lot of these junior shell companies. I mean, there was like just hearing some of the stories at conferences, some of these junior mining promoters and the CEOs of these junior mining stocks, they were not putting the money into the ground drill hole programs. They wasted tens of millions of dollars of shareholder capital.
Yeah, that there was definitely up to a certain point, like, rampant fraud, especially on the Vancouver exchange. But I think a lot of that's been kind of cleansed. I think it's been, a lot of it's been cleansed, although this this Nylum or whatever it's called.
Well, those companies, they chase whatever flavor is going up, right? So they switched, I think, to crypto mining many years ago. And then when that went into a bear market for a few years, then they switched to lithium. Then when that crashed, I think they went into uranium. So I don't know where they'll go next. Dave, you do have a track record, an excellent one, of picking out juniors. It is not easy, and the majority of people who claim in their newsletters that they're going to get 7 or 8 or 9 out of 10 of their junior selections right, I honestly don't believe them. But you've had some amazing winners with Silvercrest metals in the past, and you did give my listeners another interesting silver play at what Discovery Silver, I think you said. So I want to thank you again for your time. If my listeners want to check out your junior mining stock newsletter or the Short Sellers Journal, how did they do so?
Just go to investmentresearchdynamics.com, and there's links at the top of the blog that'll give you more information about the newsletters.
And I recommend going and reading Dave's new blog article today about commercial real estate that he just put out. It's free. It's got an excerpt in there from his newsletter. Folks, this might not happen in the next couple of weeks, but it is coming, and it is a disaster.
I agree. It's going to get really ugly.